Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate finance and business filings. This week we are digging into a Form 8K from Stellus Capital Investment Corporation. And let me tell you, this one involves some interesting debt moves and notes with numbers that might surprise you. Before we dive in, if you love getting these kinds of unfiltered business insights directly from the source, make sure you hit that subscribe button and join our growing community. Also, we have a fantastic Discord channel linked in the description below where we discuss these filings and more every day. So what exactly did Stellus Capital Investment Corporation file? Well, essentially they announced they are issuing new notes, and guess what, they are using the money to pay off some older debt. It sounds simple enough, but the details here reveal a bit about how the company is managing its finances. Let's break this down. Stellus is bringing in $50 million by selling these notes, which are basically loans from investors to the company. The interesting part is the interest rate. They are paying 7.250% on these notes, which mature in 2030. Now, why is this noteworthy? Because it tells us about the cost of borrowing for Stellus. Higher interest rates mean the company has to pay more to get its hands on that capital. This offering was part of a larger plan to manage their debt structure. These new notes aren't entirely new. They are being added to existing notes under a master agreement called an indenture. Think of it like adding more rooms to an existing house rather than building a completely new one. This means these new notes will have the same terms as the older ones they are adding to, which makes things simpler for the company and investors. It also means the total amount of this specific type of debt now stands at a hefty $125 million. So that is a significant chunk of money Stellus is owing its investors on these 2030 notes. The fact that they are issuing more of these specific notes suggests they feel this is a cost-effective way for them to raise funds compared to other options available to them. These notes also come with a fixed interest payment schedule. They be paying out that 7.250% interest twice a year. This predictability is good for budgeting, but it also means they are locked into this rate even if market interest rates fall. Now, this is a crucial detail. These notes are unsecured. That means there is no specific company asset backing them up. If things go south, investors can just seize a particular building or piece of equipment to get their money back. They are essentially lending based on the company's overall promise to pay. This usually means investors demand a higher interest rate to compensate for the added risk, and we see that 7.250% rate. It also means these notes are on equal footing with other similar unsecured debts the company might have now or in the future. However, and this is a big however, these notes are effectively subordinate to any debt that is secured. What does that mean in plain English? If Stellus has loans that are backed by real assets like property or equipment, those secured lenders get paid first before the holders of these unsecured notes get anything should the company run into serious trouble. This is a common structure, but it is vital for investors in unsecured debt to understand their place in the repayment line. Here is another interesting tidbit. Stellus has the option to pay back these notes early before they are officially due. This is called redemption. They can do this at a price that reflects not just the principal, but also the future interest payments they would have otherwise made. This is a strategic tool for the company if they find cheaper financing options later, or if market conditions change favorably for them. It gives them flexibility. Once they get closer to the maturity date, they can call back these notes at face value, essentially paying back just the principal plus any interest owed. This is a much simpler calculation and a common feature for corporate bonds. And for investors, there is a safety net. If a major event happens like a change in control of the company, the note holders can force Stellus to buy back their notes. This is a way to protect investors from unexpected negative changes within the company. These notes also come with covenants. These are essentially rules that Stellus must follow as long as the notes are outstanding. A big one here relates to the Investment Company Act of 1940. This law is designed to protect investors in investment companies like Stellus. The covenants ensure that Stellus continues to operate in a way that aligns with investor protection rules, even if they were to stop being considered an investment company under certain definitions. This is a commitment to financial transparency and responsible operational standards. So what is the big picture here? Stellus is issuing new debt at 7.250% to pay off older debt that must be maturing or maybe had an even higher interest rate. This is a common financial maneuver called refinancing. They are essentially swapping one loan for another, hoping to either get better terms, lower interest payments, or simply manage their upcoming debt obligations smoothly. In this case, they are using the proceeds to pay down their 2026 notes. This indicates a focus on managing their near-term debt profile. Item 2.03 Creation of a direct financial obligation, or an obligation under an off-balance sheet arrangement of registrant. This section here just confirms that the issuance of these new notes creates a direct financial obligation for Stellus. It is not some kind of side deal or a promise that doesn't directly impact their balance sheet. These notes are now a real debt on their books. Now let us look at the bigger picture for Stellus Capital Investment Corporation. They are operating in the business development company or BDC space. These companies typically invest in or lend to small and medium-sized businesses. BDCs are known for their high dividend payouts because they are legally required to distribute most of their taxable income to shareholders. The fact that they are refinancing debt suggests they are actively managing their capital structure. Issuing new debt at 7.25% to pay off older debt is generally a positive sign, especially if the older debt had a higher rate. It shows they are trying to optimize their borrowing costs. However, it also highlights their reliance on debt to finance operations and investments. One of the key things to watch with BDCs like Stellus is the quality of their underlying investments. Are they lending to stable, well-managed companies, or are they taking on excessive risk? The 8K doesn't detail the specific companies Stellus is lending to, but this debt issuance is a move that underpins their ability to continue making those investments. The risk here, as we touched on, is the unsecured nature of these notes and the leverage BDCs generally employ. If the underlying businesses Stellus lends to struggle and default, then the company could face problems repaying its own debt obligations. The market environment for interest rates also plays a huge role. If rates continue to rise, the cost of new debt could become even more expensive. Overall, Stellus appears to be proactively managing its financial obligations. This debt issuance is a strategic move to refinance existing debt and maintain operational flexibility. For investors, it is important to keep an eye on the company's portfolio performance, the quality of its loans, and its ability to generate sufficient income to cover its borrowing costs and pay dividends. The 7.25% rate is a signal of current borrowing costs in the market and the company's credit profile. Alright, that is our breakdown of Stellus Capital Investment Corporation. Latest filing. What is your take on these numbers and what they signal for the company? Future, do you think refinancing their debt is a smart move or a sign of underlying pressure? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives every week. Don't forget to check out our Discord community linked in the description for even more insights and discussions. Thanks for watching, and I'll see you next time.